Hey gang, I think after watching this one, you may want to give me a thumbs up because here we are once again showing where the market is with our latest indicator. This is the TSI indicator combining multiple time frames of data or indicators. Two indicators, PPS and LCC, last conditional change. Now, we just broke out of the S&Ps of the old highs back in May. We just broke out of the September, October highs. So the S&Ps, the volume momentum in our volume histogram component didn't do great because over the last couple of days, it was the 4th of July weekend. It wasn't great, but we did get a weekly close greater than this high. You would think if Monday it doesn't just puke right back down, um, we're gonna start to see maybe some algorithms and traders going, hey, wait a minute, this could be an official breakout to the upside. So Monday is going to be a good tell for us, and going into Tuesday. Seasonally speaking, the market generally does well going into about the 12th of July or so, 9 trading days or so into the first half of the month. Then we got earnings coming on us. We have no negative news or noogies, whatever I said, coming out the first week here after the 4th of July. So me come off the vacation and off the 4-day holiday feeling good. There's no shoes to drop. There's no missiles being launched from North Korea. There's I don't know. Oh, I don't want to get political, but it's hard not to in this environment. But the long and the short of it is, at the end of the day, people, they're going to probably come off feeling well. New pension money coming in off the sidelines, 401ks, people adding the money. People are starting to talk about what stock should I get into for my retirement. I'm hearing that a bunch from people over this past weekend, which is really cool. So it tells me that there's sidelined money. It tells me that people that have been scared, if they come back in, where are they going to go? Well, the first place is, do you buy a new high in the stock market? That's the first question. Do you buy a new high in the stock market? Well, considering the fact that it is a new high, but the overall performance from where we were at the beginning of 2018, then if you look at the middle of 2018, then here, and you go back and you go on a slow, steady growth rate, we've like literally only increased 2% in the market. So we've had about a 2% increase over that period of time. Now, if you bought it here, it's great. If you bought it here, well, you suffered. If you bought it here and got stopped out there and then went back in here, that would be a disaster, like a lot of funds have done, a lot of hedge funds. So what I would have to say is if this market is dynamically bullish and we're still going to see increases, volume has to come into play. That's number one. So we need to see more volume come into play. And if we do get a small pullback and all of a sudden we get launch, we could easily get this market to newer highs. And I'd say maybe a 3% move over time in the summer by earnings season could put us right up in there. Now, that's just a look-see in the market. As you can see this chart, everything is still bright blue. Why the hell would I be short? Now, maybe you don't know what bright blue means, but I think you're smart enough to figure this out, that if it's blue, the market's been going up. Interesting. If it's red and you're short, that's good. If you're red and it's long, that would be bad, right? So blue good if long. Right now, we're firing off all cylinders. We're in a blue mode. What does that signify? It signifies that the market has two time frames in sync with each other and that they are being decidedly bid up, and we have positive momentum in price. All right, let's take a look at some sectors and see where the money flow might go into the next week. And if we are going to see liftoff to newer highs, shouldn't we see the Russell play catch up? That's the next point. Let's take a look at those charts. All right, so this is the IWM, and when we talk about catch up, holy moly, let alone May's highs, we haven't even, we're forget September, August highs. We haven't gotten to May's highs yet, right? So if the market does if the growth orientated domestic small cap and mid cap stocks start to outperform those more cyclical, so if we start to see more money flowing into the regional banks, the XLF, small cap energy, small cap technology, small cap industrials, healthcare, XLV, then yes, this thing's off to the races. People have been selling this off, and they've been selling it off because they think tariffs with China and the economy is going to pot, and no one wants to get into growth orientated. They don't pay a dividend. There's no chance they're going to go out of business, blah, blah, blah. But we all know that domestic small cap growth companies, eventually, if they turn a profit, they get into larger companies and pay dividends eventually, right? So that's the trade-off. At what point would we want to start to see at least be more exposed into IWM? And I think it's now. And one of the reasons is that we have a very strong dollar sign as far as my volume indicator, and we're starting to see liftoff in the relative strength right now. Liftoff in the relative strength has not been 100%, but when the volume was trending lower and the relative strength was trending up, bad things happened. This time is different. The trend of price is up, the volume trend is up, and the relative strength is improving. So is this like one time, two times, and now three times the charm? Possibly. So by Tuesday afternoon, the first thing that I would point out to you is we close greater than 158.03. This would give me the insights that we are going to break out and get to at least 163, 162-ish in that range. What would make me feel more bullish on the Russell? Well, right now, let's go over and take a look. I wanted to show you. Well, this is something else. This is SPXL, a 15-minute system, which, by the way, is long the market. You can see it right here, long SPXL. All right, let's go over here and look at advanced decline analysis for the Russell. Wow. Almost everything firing off. The breadth of the market broke out and took out the highs. The breadth of the market is challenging the May highs, and the Russell is below the May highs. So that's got to tell you we should play at least maybe, if everything bodes well, there's something different here that is very unique, and it's the on-balance volume also supports new trend rise in participation in small cap stocks. So I think that's one of the things that's very positive. Now let's get back here and finish this up. If we are going to see a continuation or a melt up in the stock market, I said melt up, and I said this thing's probably not done yet. Then if it is not done, we're going to see maybe a pause in equities in the large caps S&P Dow, and we're going to see the Russell start to trickle higher. So you want to be watchful of that. Don't look left when you should be staring right. In other words, don't listen to the TV and the CNBC and the Fox and the Bloombergs, and when they're talking about Apple and this and that and everything and Bitcoin, when all of a sudden, sneakier than a fart in church, you got the Russell rising. No pun intended. Oh, that is a pun, but anyway. All right. Sorry about that. Here's the deal. Technical analysis is boring. I'm just telling you as I see it, what I'm looking for and what the indicators are sharing with me, and that's why I'm doing these free videos for you. Which, by the way, if you like the content, thumbs up. If you give me a thumbs down, how the hell do I know what the hell's about you don't like about it? If you don't ever come back and watch my stuff again. But what's the whole point of putting a thumbs up and a thumbs down? A, I like the content, keep going. If a thumbs down without telling me what's wrong, then I can't help you, right? So just don't click in anymore. Please opt out. I don't want you on my email list. I don't spam you. I don't sell your name. But by gosh, if there's something you want improved, how do we work together better? By letting me know what can do it. I could probably do it if you just fill in the data and say, hey, comment, John, we'd like to see this better. Anyway, here's the story. I think overall that if we're going to see cyclicals improve, the next thing that we need to see is we need to see a decline in bonds. So moral of the story is bond prices. Let's take a look. TLT. Bonds should start to go down. The funny thing about bonds is we right now haven't given it up yet. Now maybe tops take longer to form than bottoms. Maybe bonds got bid up here. People love buying bonds under 255 yield. That's great, but unfortunately, they haven't given up the bid, meaning the trend. And the trend is blue and it's up. I get that. But right now, the relative strength over S&Ps. So the denominator is S&Ps, the numerator is TLT. And so by looking at this, gang, what I would have to point out to you is we are starting to see relative strength weakness in the market. The last time we saw relative strength weakness over here, bonds went sideways for a while. No offense, but Alan Greenspan got a couple brain cells, thought bonds were overvalued 2 years ago. How does he feel about them now? In massive bubble. So what's running bonds? People are retiring. They don't need an appreciation of their capital. They want a return of their capital with a small rate of return. Well, that would define the 30-year bonds at a 256 yield, 2.56. But if we feel that the market, or investors and fund managers feel that there is more compelling evidence to get more money out of stocks in the longer term, we're going to start to see bonds pull back again. Right now, look at this volume reading. I would not want to be long bonds with a negative divergence in my volume reading and relative strength. So two things. We currently have a 131, 128 put spread on the market. When would I get aggressively short bonds? A, if we get a daily close below all of this fuchsia last conditional change, and then B, more likely not just below these lines in the sand, but this chart turns blood red. So if these candles turn blood red on my indicator, sayonara, going down, and that's what I'm watchful for. All right, XLU, in the next scope of thing, utility. Utilities are also like a bond because utility comp stocks issue what? They issue debt. So utility stocks also, relative strength has gone negative versus the S&P 500. If there's a fund manager that pays attention to RS and momentum and volume, well, here's the high from way over here in March. Here's the high in the volume reading now, and the sector's kind of gone up. It's losing its rate of change. Its rate of change and its rate of change of momentum of relative strength is depreciating, and that's pretty advanced stuff. I would say that daily closes here, and forget this 57, 54, and we're talking maybe 52. So don't freak if you start to see bonds down, and don't freak if you see XLU down, and especially this last one, which is consumer staples, XLP. I also see XLP as deteriorating with its relative strength and its volume diverging. Consumer staples have really helped to lead this market because that's a defensive play. If the stock market's getting back into legs, then we ought to start to see what these indicators are pointing to. They're indicating that weakness is coming soon, and we should see this stuff, people come out of this and rotate into the other sectors, more in financials, back in energy. And by the way, gang, let's take a look at this one little ETF called JETS. It's the airline sector ETF. I can't really say it's a big deal because it barely has 13,000 volume on a given day, on a 10-day average. But one thing that's interesting about this is that it's just tried, and it's like red, white, and blue. It's the American flag. It just keeps, every time it pops its head, it keeps failing. But this time around, it's interesting because we're starting to see the relative strength turn a little. You had a longer term convergence, and now we're starting to see that volume pop. So if we get a breakout of these highs again, with this time of a convergence and a longer term volume trend, man, airline stocks could be something special. After all, they haven't moved in a long time. So this could be, I don't know, a ploy for maybe institutions. They don't want all their cards to be seen, so they get into one sector, they lay off it for a while, they go to another, then they go back to that same sector. Watch airline stocks. Now that I've zoomed this up, guys, this has a very powerful convergence pattern, and it's not like they're, jets could easily run up. I mean, that's a 12% move. So I'm not saying 12% is going to make you, filthy rich, but it's UAL. It helps the supporting factor that we could have a breakout in United Airlines. American Airlines is AAL. Certainly has a long way to go. Delta Airlines has earnings out this week. It's at the top end of a shelf of resistance. And then we have all of what I call the discounters, like Spirit Airlines, Alaskan, ALK, Alaskan Airlines. And then JBLU, JetBlue, by the way, is starting a huge base, as you can see in the price action here. And I'll just finish this up, guys. And if you look at JetBlue, and you say, well, what are you talking about, a base, person? And it's real simple. The base is simply this. We've got a little bit of a movement. And I'll try to get this up for you. Right here. That's a strong little base. I would say technically that's a little resistance. We have relative strength, not really performing much, but the volume needs to kick in. And if it does, JetBlue, could it go? I mean, if you think about the overall ETF going up 12%, can it get back to its, what, 17 highs, $23 a share. That would be for JetBlue a pretty good move, right? So there's a lot of capacity in the market right now for sectors that have been abandoned by investors. I don't think I have to tell you anything about oil and gas exploration. It's decrepit. Look where it's at. It's against 2015, 2016 lows, for example. So if we are to see an increase in growth, people consume energy. Energy should be going up. If the economy is doing well, people should be doing and getting healthy loans, buying cars, houses. Banks should be doing a little bit better. So that's the cyclical aspect of what I'm looking to see, and I want to see the defensive stuff down. Lastly, with that said, GLD. Everyone's in gold. Everyone loves gold, and gold had a good run. We had a portion of gold in the format of Newmont mining, but now I look at gold and I go, it's interesting because the volume indicators, while they did have a big breakout on that last leg up here, I would have to tell you this: gold can continue to break out as long as we do not get closes and these bars turn red, because the relative strength versus the overall market is weakening, and the volume structure, and this is weakened, as you can see, but that may just be only because of last week's holiday. A close greater than that yellow line in the sand, I mean, it's like trend, pullback, and breakout to newer levels, and then we'll see what this volume has to say. So the moral of the story is, with gold, I think it's up on different reasons other than fear of inflation and fear. It's cheap money. There's liquidity. There's tons of liquidity in the market, and thanks to the Fed and global central bankers lowering rates. So there's tons of liquidity in the market, and maybe people are stocking up on gold. With that said, what do we think about foreign markets? After all rising tide floats all boats. Is now the time to maybe look at emerging markets or other ETFs of foreign companies? And I don't know about the EEM right now, to be honest with you, but I do see a lackluster volume trend in this. So to me, I would say maybe until we get this momentum reading back on a daily basis turning positive of the volume and the relative strength, which is still just turned green, until we can get a confirmation of good volume reading and an upturn in the market, I'd have to say hold off. But it does look as if it could break out and go. Watch the volume on EEM. FXI, last but not least, is China doing better? It looks just like the EEM chart, right? The same story. We want to see the relative strength outperforming bright blue. There's no volume in this trade. It went up with no volume. Was that the 4th of July or just who cares, right? Because it's the China FXI. I can tell you this: if we are to see rising tides floating all boats, holy moly, this thing has just better than the I would have to say just a little bit better than the Russell as far as catch-up is concerned. But what do I need to see to really get behind an improved outlook for FXI rallying? Volume. I need that volume histogram. I need it to turn positive. I need those moving average lines to pop up. Thanks for watching. I hope you had a great 4th. And in celebration of the 4th, we have our new indicator, the TSI, available for TradeStation users. You can find it on the App Store. TSI, Person's Planet. Come by. You can just get that all by itself. It's kind of cool. You can lease it per month. That's an awesome feature. And as you can see, this thing turns bright blue. It gives you areas to get long. It helps you to stay with the dominant trend of the market, and it teaches you if it breaks support, to pull the ripcord. Anyway, I think you're going to find this to be, it is actually one of my favorite tools now, because I've been doing it manually, looking at 2 different time frames. And if I could share this with you, I've been always looking at 2 different time frames in the market. I have to see, here's the PPS over here, and here is the PPS on an intraday basis. So if the 60-minute is long, and I want to see if the daily is long. So these are why we had the radar screen helping us with 60-minute signals against daily signals. And then we've had to look at, again, on our higher time frame, we would look at our daily signals against weekly signals. And in fact, we can even have said even monthly signals. Those are the monthly signals. So that's the neat thing about the TSI. And here's the better thing: it's not just a one fixated program where you can't choose your time frames. We are allowing you can change your time frame. Right now, this is the FXI with a daily, weekly, and for day trading, I could just format this and I can change this to an intraday minute, and I could go, let's go 60-minute, or I could even do a simple 5-minute change, and then I can go over and make my dominant time frame, change that from 5-minute weekly, go back to daily, and I could use a minute chart here and go 60 minutes. So when the 60-minute is in a buy mode, I'm only going to want to take 5-minute buy signals. So that would tell me when the market, and we could do that with the, for example, E-mini S&Ps. So when you get this 60-minute, one time frame changes from dark red to white, it says a change is coming. And when you turn blue, for example, this tells you that your 5-minute time frame is in a buy mode and the 60-minute is in a sell mode. And that for day traders, you could kind of help to underscore where when we get trend days, by the way, like this, here's a beautiful buy signal, and against all of the last conditional change, it turns white, it goes right back into blue. There's your stop, stop, etc., etc. Beautiful way of looking at the market with identifying higher and lower time frame last conditional changes. Remember that these purple would be the 5-minute and the green would be the daily. So you could say, gee, or the 60-minute in this case. You could say, listen, I want to buy, but instead of using an ATR method, you would say, hey, as long as the market doesn't take out the 60-minute supports, as long as it doesn't take out the 60-minute support, I'm going to still lean against the trend on the long side. That's how this is one of the most efficient tools, and you, the user, get to change the time frames in which you want to trade the markets. Thanks for watching. Hope you had a great 4th of July, man. Seriously. We'll see you next week. Bye-bye.